Welcome to Investing Insights. I'm your host, Ivana Hampton. What people want to drive is changing. There's pent-up demand to buy, trade in, and trade up. Morningstar Research Services U.S. Autos equity analyst Dave Whiston shared his industry outlook in part one of Where Can the Automotive Industry Go From Here? He explained why he thinks car makers already experienced a recession, so check out part one in case you missed it. Now, Dave talks about the shift to electric vehicles and two cheap stock picks. As you mentioned, uncertainty centering around the economy. You've written that there are reasons to be optimistic about U.S. auto demand. One of them is that many people are driving old cars. Let's talk about that.
Yeah, so the fleet age, basically, it tends to creep up every year. I mean, cars are more durable than they were, say, in the 70s, for example. But there's also a certain element of people putting off a purchase, either for economic reasons or because the inventory just hasn't been available the past few years. But you can only defer, and you can do a lot of maintenance and whatnot, but you can only defer certain things forever, and then accidents can still happen, or you can have a major powertrain issue. Gasket work, something like that can be really expensive. You might just say it's time to buy a new car. There's also, safety reasons, honestly. I mean, I still remember watching, when I first started years ago, I used to cover Autoliv, a company that does automotive safety equipment. They love to show safety videos at the end of the presentation. I still remember one where they took a giant big, they're Swedish, so they took a big Volvo station wagon that was older than a smaller car that they had, and then they smashed them head on. And you would think, oh, well, the big station wagon will win that battle, right? No, that giant station wagon, it folded up like a paper cup. And that's always struck me, and I've always remembered that. So, for those that have the means, I think just for safety reasons, I think it's helpful not to have a car for 15 plus years, just because the safety features do get better, and the structural integrity of steel, the steel body and whatnot, it gets better over time. So in addition to safety, there's other reasons you might want to buy a new car. Your lifestyle needs may change. Families get bigger or smaller. You can, of course, you might be forced to because you have an accident, your car gets totaled. But there's also just the tech and safety in a car is so different in 2023 than it was in, say, 2007. When I started following the industry, I mean, now you've got 4G Wi-Fi in vehicles, and even 5G is on its way. You've got passive and active safety, like lane departure and all the LiDAR, radar sensors, things like that. You've got, if you want to spend a lot of money, you can do things like Tesla's autopilot mode, a term I use generously because that's what they call it, and their FSD technology, and then GM's got their Super Cruise technology, and they've got Ultra Cruise coming out on the Cadillac Celestiq very soon. I think that's next year or late this year. And that can drive on about 95% of all roads. You just need to still be paying attention. So there's a lot that's different, even compared to, say, 2015 too. So there's just a lot of reasons to get a new car if you've got an old one. And then also you've got the continued trend of more Americans wanting light trucks, which are pickups, crossovers, minivans, SUVs. That's now about I think in the last month it was 80% of all new light vehicles sold in the U.S. were light truck models. So if there are always people that have that Honda Civic or Corolla, let's say from 2009, but over time more and more of those people have traded up to a light truck such as a crossover. Crossovers are north of 45% of sales.
So with the new safety features and other tech gear inside of cars, how are automakers going to convince people to buy or lease a new car?
Yeah, I think with ultimately it's for whether you want to buy or lease the vehicle. I think ultimately it's about having the right level of inventory, and we're just not quite there yet. It's going to be a little. You've got kind of two competing forces this year, and then you've got poor affordability and rising rates, combined with inventory finally starting to get better, but still has a ways to go. So it'll be interesting to see. I haven't seen consumers completely walking away yet, but you never know if things get worse. I mean, interest rates. My opinion on this, and I've asked some dealer CEOs about this. they're high, and it's the average new vehicle payment right now is over $700 in this country. If you want to lease, it's like $578 in the fourth quarter. That's too high. As trim packages get more wider and you get some lower option trim packages, I think that'll help bring pricing down too. But rates right now on the new vehicle side, it's a little over 6% on average. We can probably go, by my math, just looking at the sensitivities, this has that payment change using 69.4 months or so as the loan term for every 100 BIP increase. What does that mean to the rate? Generally, it's something like $18 a month. But 100 bips is one thing. If you start to get, like I said, well north of 10%, I would get more concerned. So I think that the Fed can raise rates a bit more. Will they? Remains to be seen. Perhaps the recent regional bank contagion risk and the collapse of SVB and Signature Bank, maybe that'll give the Fed reason to pause or at least moderate its rate increases. We'll just have to wait and see how that plays out. But it's going to be choppy and lumpy. I mean, what would really scare me would be, do rates go back to 1982 levels where a new vehicle loan rate was nearly 18%? That would be a disaster. But hopefully we will not go there. I don't think we will, but obviously you never know.
Well, will the trend of new car loan terms stretching out, will that trend continue?
Yeah, I think on duration of a loan, I mean, it's roughly 69.4, 69.5 months right now on average. You do have some 7-8 year loans out there. Not a ton, but there's only so much you can do with a car. Going to say a 30-year car loan like you do with a mortgage, it doesn't make any sense because the collateral profile on a house versus a car is totally different. And generally, someone who buys a new car, they might hold it on average roughly 5 to 6 years. So I think it'll creep up a bit. One, because of pricing is high, and that's one of the key ways you can manage that monthly payment. And a lot of it isn't for the consumer. A lot of times it's all about just what is the monthly payment. It's not even what is the interest rate. They just want to get the monthly payment to something that works in their budget. And that's the way you can do it, is with the loan term to a point. One thing to keep an eye on too, though, is the risk of negative equity, which is, when you're trading in, do you still owe money on that car that you're trading in? It's weird. I see fear mongering articles about this in the press quite often. I've asked the dealers I cover about it. They never seem worried about it. They always feel like they can work around it, and they have, honestly. And for the most part, they do third-party lending with a few exceptions, but their third-party lenders seem to be willing to make it work somehow. Generally, you have to roll the negative equity into a new loan, so that could keep sales. Maybe I wouldn't say it's going to freeze sales, but it might prevent sales from getting to, say, 17.5 million immediately after the chip shortage is over. But it'll be an issue for a bit, just because you've got people who have bought and now pricing is coming down. They may need to hold on a bit longer before they buy.
Can you explain this shift and why drivers are now favoring crossovers and SUVs over sedans?
Yeah, so light trucks were about 45. They got down. They fell to about 45% of new light vehicle sales around 08 or 09. You'll recall, before Lehman Brothers collapsed, gas prices were sky high, and you had things like a used Prius was selling for more than a new Prius because everyone was freaking out about gas prices. But over time, that mix has now gone up to 80%, as I mentioned earlier, and you've got a few. I think there's a couple of variables there. One, there is a bit of a stereotype, but I think it's a stereotype because it's true. Most Americans do like larger, bigger vehicles. They feel safer. They feel like they have more command. They feel they can see better if they're up high. There's still people. I'm in the minority here, but I still personally prefer sedans. So I don't think sedans will go away. But crossovers have made it a lot easier to go into light truck. Especially if you aren't a minivan person. That's, some people are, some people aren't. But you've got a lot of options now. Whereas before, if you wanted to go, you didn't want a sedan, you had to go all the way up to, well, in the industry, we call a body on frame SUV. Think like a Cadillac Escalade, Chevy Suburban, Tahoe, really big hulking vehicles like that. Those are actually made on a full size pickup truck platform. Crossovers, on the other hand, are what's on an industry process called unibody construction. Basically, the same kind of platform and body of a car. You just have rejiggered some things to make the vehicle higher and have more cargo space. And so, basically, you don't have to give up fuel economy now, at least not in any severe way, to get more space. And sometimes the pricing isn't all that different either. Just an example, that I'm going to mix vehicle segments here, but take the Camry as a typical mid-size family sedan. Back in the day, that would perhaps been your family vehicle before crossovers. And then one of the leading compact crossovers out there is the Toyota RAV4. So looking at starting prices, the RAV4 starts at about roughly $1,800 more than the Camry. And so ignoring interest rates, if you just divide that out over, I think I did this over 69 months, if I remember right, but that comes out to an extra, I think $27 a month. So it's not a lot per month to go price-wise to go up there to the RAV4. And then in terms of fuel economy, according to fueleconomy.gov, you're on a combined fuel economy basis, you're only losing 2 miles per gallon between a Camry and a RAV4. So it's not a big difference, but then you get, in terms of cargo volume with the RAV4, you get about 2.5 times more cargo space. So it makes it easier to switch up to a light truck. And then you throw in things like feeling safer, higher, whatever of driver's preferences. And now you're at light trucks at 80%.
Well, mention electric vehicles, and the name that probably comes to mind is Tesla. You've written that GM is the one to watch. Why, Dave?
Well, Tesla is still the leader in terms of the all-electric segment, or what I call BEV, or battery electric vehicle. All-electric vehicle. Tesla's still the number one player. They have a little over 60% share last year. That's down from, I think, 77% a couple of years ago. Basically because the industry, and GM's been a leader in this, the industry is finally making an effort because they see a path to making EVs profitably. They're actually making desirable BEVs now, rather than these awful econo boxes that would get 80 to 100 miles on a charge. And of course, nobody wanted, and go figure, right? So when you look at GM's EV portfolio now, people probably think of the Bolt and the Bolt EUV, but there's a lot more to it than that. Those are actually on an old battery platform now. And that one is under recall, but the new platform Ultium is not under recall, and there hasn't been fire risk, at least in a major way, reported with Ultium yet, to my knowledge. So you've got vehicles now like the Hummer pickup truck that's already out in, I believe, 2024. The Hummer SUV EV comes out. The Cadillac Lyriq crossover is already out, and that is I think a very worthy competitor to the Tesla Model Y. Now, there's charging network differences, that Tesla has the supercharging network and the other automakers don't, although Mercedes wants to go that path. We'll see how that works out. Personally, I've been critical of Tesla's interiors. I don't think yes, it's a modern, futuristic interior, but to me, it's just not luxurious and worth the price point for what they charge. I think they should offer a better interior. And you get that now when you look at like a Mercedes EQS, you look at the Cadillac Lyriq, for example. These are good looking, desirable EVs with really good range, up and around the 300-mile range per charge. And then there's more coming from GM. You've got the Silverado EV this year. The Sierra comes out next year, I believe. And then this fall is really interesting. You've got a few crossovers, the Blazer EV. And then this fall is the Equinox EV that's going to start at $30,000. And I think this is going to be a very interesting vehicle to watch, because this is the first true high volume attempt to go after the mass market customer with an EV that's actually desirable in terms of range and amenities and whatnot. So it's going to be interesting to see, does that Equinox do really well? Whereas, say, something like the Tesla Model 3 has done very well. Can the industry get success in EVs beyond Tesla? And I think GM's Equinox is going to be a really good, I hate to use the word experiment, but a really, really, really interesting thing to watch in terms of the mass market adoption of EVs. At a bit higher price point in a different segment, you look at something like the Ford Lightning pickup truck EV that has done very well. So I'm optimistic for the Equinox, but ultimately we'll see what happens. But yeah, there's a lot coming from GM, and they do believe in an all-electric future. I believe both Cadillac and Buick will be all-electric by 2030. and their whole company they see going electric, all electric by 2035.
Now, GM is calling itself an auto tech company. Can you explain why they're doing that?
Yeah, that's a term I heard CEO Mary Barra use in an interview, and there's a lot going on at GM, and really in the whole auto industry beyond just selling cars now. In GM's case, you've got several new businesses. They outlined all this in October 2021 at an analyst day, and introduced some pretty aggressive financial targets for 2030. But they're looking now for 25 billion in revenue by 2030 in what they call SES, just software enabled services. This includes 6 billion from OnStar Insurance, which is already commercialized in the marketplace, and also 10 to 15 billion of revenue for various subscription services. And this will be for a wide range of things like you could possibly get Super Cruise or Ultra Cruise on a subscription basis, as opposed to just buying it up front. Or you could do things like customize various things in your vehicle, whether it's the console display to be personalized to something you like. I think they use an example in the slide deck of the PGA Tour if you were a golf enthusiast. But you can expand this over time too, especially as you get perhaps more quasi semi-autonomous capabilities in vehicles, where you could have more. You could do gaming, e-commerce, infotainment, augmented reality, virtual reality. Even there's all sorts of things perhaps down the road you could do with that. But again, 25 billion of revenue on nascent to non-existent businesses today. GM's talking about 80 billion in revenue by 2030 from things that are either nascent or non-existent today. And the single biggest piece of that 80 billion is 50 billion by 2030 for their Cruise autonomous vehicle subsidiary, which they own about little over 80% of, along with some other big players like Honda and Microsoft. Cruise is really interesting, and I don't think GM gets enough credit for this at all. That is level 4 autonomous technology, meaning geofence autonomy. And they'll have the Cruise Origin. It's supposed to start being produced this year. That just has a passenger area. There is no driver's console area. That is an autonomous vehicle. I've been inside it. It's quite spacious and comfortable. Tons of legroom. And you just get in, and it looks like a giant pod basically. And it takes you, and it'll just take you within any geofenced area in the city it's operating in. They are already offering commercialized where consumers pay for level 4 robotaxi services in San Francisco, Austin, Phoenix, and they're the exclusive robotaxi provider starting this year for Dubai. So this is the kind of thing I think if Tesla was doing it, it would be considered amazing. But for when GM does it, they don't seem to get the credit they deserve.
The audience can probably sense that GM is one of your picks. Dave, lay out your case.
Yeah, so I've said this for a while, and I know it's been frustrating at times. It's gone up, it's gone down, and mostly has been getting held back. There was always a fear of when are we going to have a recession? Well, you just had it in 2020. You look at the cash flow and the EPS GM's delivering, it doesn't seem to me, it doesn't seem worthy of a company that should be trading at a forward PE multiple of 5 to 7, 6 to 8 times, but that is the reality. This is a radically different company from old GM. They break even. They can break even now in North America at what would be basically 2009 sales levels, which in my opinion we probably won't even see again anyway. And even if we did, I think with the per capita population math, you'd be at more like 11.4 million now, or 11.6 million, something like that, not 10.4 million like we were in 2009. So you'd be at a higher volume anyway. But much more different company. And then the 2030 financial targets they outlined in October 2021, that's 300 billion in total company revenue, adjusted EBIT margin of 12 to 14%. If you do the math on that, you would assume tax rate and you assume no more share buybacks between now and 2030, even though they are buying back shares, you would get to an EPS of $20. And if you even keep the PE multiple close to where it's been, do 8 times, that's $160 stock. That's more than 4 times where it's trading right now in mid-March. And if you discount that back to the present, it's only within a few dollars of my current fair value estimate, actually. So to me, I think people need to realize that new GM is much more efficient than it used to be. they're capable of generating, probably in the range of 8 to 10 billion a year in free cash flow. And in terms of automotive free cash flow, you've still got a growing captive finance arm because they had to start their finance arm from scratch. Remember, they got rid of GMAC and then bought AmeriCredit, and they've rebuilt that in terms of GM Financial, and that's no longer just a subprime lender. That's mostly a prime lender now. For me, current stock levels in the $30 range, I just don't think that makes any sense. I mean, obviously, there's a lot of fear right now. I'm not blind to that fact, and yes, inflation is going to be an issue probably beyond 2023, but GM has shown that they can execute in difficult environments. And again, with these new SES services, with Cruise going to get a lot bigger, especially in the second half of this decade. That's where most of Cruise's revenue growth is going to come, is going to be post 2025. You're looking at a company that over time, its EPS should keep growing well above the 7.5. It did a little less than $8 a share last year, but you can certainly get beyond double digits here because it's not even selling those data services to consumers. You can sell it to governments too. With OnStar Insurance and other data the vehicle's collecting, they can do things like say, well, this is where in your community people are wearing their seatbelt or not wearing their seatbelt. This is where you have potholes. This is where you may have potholes. This is where you need to do road maintenance. And according to GM's research, every dollar that a tax authority and maintenance that a taxing authority puts off on fixing a road, that eventually costs them $7 later. So if you can get smarter with the data, GM can sell that data and help bring in some more asset light revenue, which will be higher margin revenue than selling cars. Of course, ultimately, you still have to have a great product at the end of the day.
Well, let's move to your other stock pick. This auto supplier is rarely cheap. Tell us why Gentex is a buy.
Yeah, Gentex and CarMax are really two of my favorite names that I cover, and just in terms of the business quality, they're great stories, great companies, and both are rarely cheap, and both are undervalued right now. And we'll stick with Gentex because you asked. So Gentex, they make you may not have heard of them, but they odds are if you have an auto dimming mirror in your car, Gentex made it. They have about 90% market share of all the world's auto dimming mirrors. It's done through electrochromic technology. Basically, with Gentex, you've got a debt-free, cash-rich balance sheet, a fortress balance sheet, and they're buying back a lot of stock now. They're much more aggressive about it since the current CEO, Steve Downing, took over at the start of 2018. They've reduced their diluted share count by 20% during his tenure. They do pay a modest dividend as well. But again, you've got the dominant market share, debt-free balance sheet. So it's a name for me that I like to mention to clients for those that are apprehensive about investing in the auto industry because it's highly capital intensive. It's highly cyclical. Some people don't like the union thing. There's a lot of reasons to hate the auto industry. I get that, but if you look a little deeper, there's some really interesting names out there, especially in the supplier and dealer space, that are perhaps off of people's radar screen because they just think of the OEMs like GM, Ford, Toyota, et cetera. But Gentex is a great company with really tech company like margins and more comparable to Garmin's margins in terms of EBIT margins than to an auto supplier. They're way above the other auto suppliers. Their EBIT margins are north of 20%. Gross margins generally in the mid 30% range to upper 30% range if things are going well. It's been held back a lot because of the chip shortage that's hurting all the suppliers right now because they can't get the volume, and there's a lot of inefficient manufacturing going on at all suppliers because they'll be ready to do a batch for a customer, and then the last second the customer says, "Never mind, we don't have the parts. We have to not make that vehicle right now," so that trickles all throughout the supply chain upstream. But that will eventually get better as the chip shortage gets better. So I do see Gentex as undervalued. It's not drastically undervalued to the point where you're going to double in my opinion, you're not going to necessarily if it were to go to my fair value estimate, you're not going to double your money or triple your money from current stock price levels. But it's an attractive name that's very high quality. And for those that are apprehensive about the auto industry, I think it's a great name to think about or at least have on your radar.
All right. Well, Dave, thank you for your time today and your insights into the U.S. auto market.
All right. Thank you.
That was part 2 of Where Can the Automotive Industry Go From Here? Be sure to check out part 1 if you missed it. Thanks to Dave for sharing his auto industry outlook that included why 2024 could go in one or two ways. I'm thanking lead technical producer Scott Halver and senior video producer Jake Vankerson. And thanks to everyone who checked out today's episode of Investing Insights. Subscribe to Morningstar's YouTube channel for new videos from our team. I'm your host, Ivana Hampton. I'm a senior multimedia editor here at Morningstar. Take care.